Hello, my name is Jeff McTague and welcome. At my last webcast, The Value of Past Performance, I believe I offered significant research results which conclude that even long-term past performance has all the success of a coin toss when it comes to predicting tomorrow's leading fund performances. Then I ask, if long-term past performance cannot predict tomorrow's leading mutual funds, how then do you successfully select mutual funds for your clients? With single focus, I set out to see if successful funds had traits common to one another. I discovered that mutual funds have 11 traits that lead to successful fund selection. In this webcast, supported by the facts of my research, I begin to reveal them to you. Respecting the value of your time, rest assured I will not hurry, and we will get through all 11 traits. I might even show you how to score your firm's recommended list using these 11 traits. So here we go. Trait number 1, assets under management, or as we call it, AUM. A fund manager once told me, quote, "When my fund was small, I bought stocks I loved. Our success made us larger, but I still managed to buy stocks I liked. As we got even larger yet, I hoped to purchase stocks that I wouldn't wind up hating." End of quote. While this is an interesting anecdote, does research support the notion that fund size should be considered in fund selection? Now, the Investment Company Act of 1940 says a fund must register as either diversified or non-diversified. If a fund selects diversified, and most of them are, with respect to 75% of its assets, it may not put more than 5% of the fund's assets in any one issue, and to keep the tail from wagging the dog, it may not own more than 10% of a single issue. If I type size and mutual fund performance into a search engine, I get 2.6 million hits. Therefore, I did not discover the relationship between a fund's AUM and its competitive performance. But it stands to reason that at some point, the Investment Company Act's 510 rule negatively impacts fund performance. At some point. In 2004, a group of academics claimed they were the first to find strong evidence that fund size erodes performance. Evidently, Mr. Chen from UCLA, Hong of Princeton, Huang at Stanford, and Kubik at Syracuse never heard of me. I conducted my first research efforts on the relationship between fund size and fund performance back in 1998. For the year 1997, while it was true that the funds with less than 500 million represented a great deal of the test, it is notable that 3/4 of all top quartile funds had assets of less than 500 million in AUM. So smaller funds had a great deal of success. I also found, as did Chen, Hong, and company, that fund size mattered most in small cap than in large cap. Think about it. Where will the 510 rule come into play more? The smaller the size of the companies being purchased, the sooner the rule says no more. At this point, the fund manager has a choice. Close the fund to new investment, drift into other investing styles, or suffer from poor performance. I believe that this regulation has a real negative impact on successful funds as they try to invest an ever-growing pool of money. If a mutual fund manager cannot purchase stocks that exceed this 510 rule, it forces funds into purchasing so many different issues that they wind up looking and performing like an index fund without the cost savings associated with index funds. Since that time, I've conducted 15 surveys of funds with at least $1 billion in AUM. I examined domestic large cap, mid cap, and small cap to see how many of them were closed to new investors. I believe funds would shut off inbound cash for only one reason: the inability to properly invest the funds. Here's a summary of the results. As you can see, 5% of all large cap funds have been closed to new investors at one time or another. However, 18% of mid-cap funds and 31% of small-cap funds have spent time closed to new investors. The fact that the overwhelming number of funds closed to new investors is in the mid and small cap category indicates that the negative impact of size is most clearly felt among funds purchasing smaller companies. The 5-10 rule and the smaller asset size companies targeted in these categories conspire to significantly add to the number of fund holdings, diluting the fund to near index proportions. These closed funds recognize that having more money to invest is sometimes bad for business. So trait number one in my fund selection process is AUM, assets under management. All things being equal, and they are never equal, I favor funds with smaller AUM, especially in mid-cap and small-cap. I thank you for watching. I look forward to having you join me for the next webcast, when you will discover trait number 2, management style. Which is better, star performers, team or committee managed funds? You'll find out. Until then, this is Jeff McTague reminding you, unless you can prove it, it's just your opinion.
Right here, right now, right here.